Well, we're going to do a fun perspective on your 25 years here at BBR. I thought it might be good to start with the two bookends. What did BBR look like, just in summary at the beginning, and what's BBR like today?
In some ways, the bookend of the start is unrecognizable compared to what it's like today. The five of us sort of had an alignment in terms of what we believed and what we wanted for a business. And so we took that idea and we made some tough career choices to leave the good jobs that we had and start from scratch. And from scratch meant literally from scratch. So day one was in Brett's apartment. That was where we spent our first few months, surrounded by computer boxes and makeshift desks, and his soon-to-be fiance's clothes all around us. We got going. No clients day one. We could talk a little bit about the business and the mission in terms of then versus now, but who we were in terms of having anything to really count on for steady income was pretty much nil. And where we are today is we have 190 people at the firm in 3 offices, New York, Chicago, and San Francisco. We manage money exclusively for wealthy families. There are about 180 families where we're overseeing their wealth, and that's $32 billion. So the average family wealth is about $150 million.
So if you take me back, you said you had a few ideas of what this business would be. What were those ideas back at the beginning?
I'll give you the big idea, which is what it is today, and that is to deliver for wealthy families. It is to provide a singular pursuit to give them peace of mind that their financial needs were going to be met. How we were going to do that was very wrong. But what we wanted to do wasn't. And it is exactly what our mission is today. And it's part of our culture. It's who we are. And we took not a new service need in the terms of wealthy families always had, complicated financial lives. But what we wanted to do is take the lessons that we had. Brett and I both came from Goldman, and our other founding partners also came from big banks, and say, there are some flaws in that model. What can we do differently as a boutique without legacy issues, without being a bank, to be able to do it better?
What do you think you got right?
I think the investment philosophy we got right. In early 2000, most independent advisors were 60-40, and they picked stocks and bonds. And the big innovation, and you'll know as a Yale guy, Ted, it was David Swenson's, pioneering investment management. I think it came out in early 2000, like literally right as we started.
Right.
And so then it became stocks, bonds, and other. And we had a philosophy that it wasn't about stocks, bonds, and other. It was about building sophisticated portfolios that wealthy clients were not taking advantage of in the different ways, whether it was RIAs or banks or trust companies, and doing it thinking about long-term wealth and what they wanted to achieve with their wealth using sophisticated strategies. That was probably part of our very first deck.
Yeah.
And it's still part of how I describe how we think about it. So I definitely think, how we invest has changed, but the philosophy behind how we think about investing and building portfolios, purely philosophically has not changed at all. I think we nailed that from the beginning.
Yeah.
And it worked well from a timing perspective, because if you think about the dot-com boom being in full swing, the market hit its all-time high within weeks of us starting. We actually started managing money technically April 1st, I believe. 2000, 2001, 2002 didn't do well for those 60-40 portfolios or those traditional alternatives. We did really well. And so I think that philosophy served us really well out of the box, just by making money, not losing money for those families those first few years.
What was interesting is our profile, right? We were young guys in our 20s. And so I think we were seen as
late 20s, come on.
Late 20s. We were like dot-com believers, right? We had that profile, right? It was our generation at the time that was leaving the big firms to go do startups. But we never believed in it. We always felt like it was a bubble. We always felt like it wasn't, we were we're too academic, we're too institutional in the way in which we think about investing, then we couldn't ever make the numbers right. So our first few clients hired us knowing we weren't going to participate in any of the potential upside that was going to come through IPO allocations. It wasn't going to come through, us betting, on, networking stocks at the time.
E-toys.
Yeah, right. Pets.com. And so we earned a decent amount of unexpected goodwill from our clients when, to Brett's point, the market cracked so early after we got started and they were protected.
What were some of the other important kind of first principles of your business as you laid it out, in addition to this kind of broadly diversified investment approach?
Well, the principles really were to create peace of mind for wealthy families. And once that's your North Star, you build the whole firm around that. And I think one of those sort of early aha moments for us was a few years into the business, and we were meeting with a client who was financial professional, successful on Wall Street, and he said, I want you guys to know something. He's like, I've given my wife your business card. I told her, carry it in your wallet. If anything happens to me, that's the number you call.
How do you build the culture of an organization around that idea of providing that peace of mind for your clients?
Yeah. First of all, it starts with everybody's needs to row in the same direction. But the idea of assembling a boat of rowers where the whole is more than the sum of its parts. And that's because you've just got to put that together where you've got complementary skills together. And this is not to pick on Goldman. They are a great firm. We would not be here if it weren't for them. But that firm is where there's tension between the goals of the individual rep and the firm's goals. And we said, that's just not for us. And look, we had a huge advantage. We started in 2000, not in 1862. We could start from scratch and say, nobody at BBR gets paid on commission, right? Everything's oriented towards team. Put the team together. The person who's involved in a client relationship, who's handling moving money, is just as vital as the person who's actually making decisions around investment strategies. And when everybody feels a sense internally of oh, I matter, I care, I impact the relationship with the client, I think it brings out the best in them. And I think that is a big secret sauce of how I wish we could replicate it, put it in paper. I think a lot of it's leadership by example. But in the end, that is what I think differentiates us. And I think it would have been a lot harder if we'd had a different model of still being around 25 years later.
Mm-hmm. What have been some of the biggest bumps in the road? So those initial principles you were able to hold for 25 years. I imagine not everything was smooth along the way.
So Brett and I always joke that he's the glass half empty guy and I'm the glass half full guy. So
does that mean
maybe
Brett
should answer this question.
Well, so as it relates to that, it's interesting. There are a few firms that looked like us. Some we were familiar with, some we weren't when we actually launched. And I know we thought we had a very creative idea to provide this highly customized, high touch, very full service approach to families and to be their profit center, right? And there are other firms that do that. But over those first few years, this is a great example of the half full, half empty. Lots of firms started up. We were very early in this trend. And every time I heard about a new firm or someone leaving a bank or private equity firm backing a firm in this, I would walk into, I'd say Evan's office, I'd walk over to Evan's desk and I'd be like, we're toast. There are so many more competitors in this business. And every time Evan would look at me, he's like, no, that means we're onto something and people are doing what we're doing. And so the space went from something we had to describe to one where ultimately we described why we were different than others in that space. Yeah. The other thing we did in 2007 was hire a management coach for us as founders. And, we all had mentors at Goldman and at GAM that we could look up to. But as Evan said, we were pretty young when we started this business. We hadn't managed very many people. And all of a sudden we were managing a reasonable number of people. And I don't think we were doing that well. And so having someone come in and say, here's how you actually run a firm. Here's how I can be your coach to help you be a better executive and a better manager.
Once you're more transparent with your staff when you're working through what their goals are, you're more transparent than the next step with the firm. And so we started doing town halls as a result of the feedback that we got from the coach. And I think that just opened us up.
Any other light bulb moments from your coaches?
We were really good at learning from our mistakes. I used to say we made every mistake, but we never made them twice. And the coach looked at me and said, why make them the first time? And, we hired a COO. We hired, technology folks. We hired a head of HR really early. It's like, you guys don't know that stuff. And yes, you make mistakes and then you don't make them a second time. Why don't you go get the expertise you need? You're a real firm to not make those mistakes the first time.
Yeah. The other light bulb moment was when the coach said to each of us differently, which is, you can't solve every problem. And I think that is also like sort of a point that is, if you want your firm to grow and last, in addition to you, to pass it on and have a real legacy, if you are, in the end, the bottleneck, every problem has to come through you because you've got this inflated vision of your capabilities of being able to untie every knot, your business is going to get stuck. And, that's... And once you start thinking other people are as good as you are and are actually capable at figuring out a problem in a different way than you are, and you see that all the way through, you start to, again, sort of let go of the till and trust other people at the firm.
I think we've developed a real brand in this industry in a lot of ways, but it has nothing to do with our name. I think it really just shouldn't be initials, right? Yeah. The firm's not about Brett and Evan at all anymore.
The part we chose intentionally was partners.
Totally.
Right? We didn't do BBR Inc. or BBR LP or BBR Corp. We did have a premonition that it was going to be more than the three of us. I'd give us a little bit more credit for that.
That's very fair.
Between the bookends.
Yeah.
What have been the most important milestones in the business that led from the early lessons, those early examples of how you're getting better, to where we are today?
2008 and 2009, that was new. That was a big, anybody who lived through that, I can still feel it. I remember it was a point where our clients were in free fall. They were in panic mode. No matter how much we diversified their portfolio and had lots of strategies that were uncorrelated, it didn't matter. And so learning to get ahead of that, right, is actually talking to our clients before they called us. And then the other is, okay, this is going to create some tremendous opportunities. And do we have the guts to be able to invest in strategies that are down 80 or 90% because we know their true value is much higher than that? And we did. We didn't get it 100% right at all, but we made some pretty big, at the time, big bets for our clients that said, we think this is overdone and here's how we're going to take advantage of a total dislocation in the market.
And that, how do we think about super long term for how the firm be structured? And that was a huge mind shift for us.
How did that super long-term mindset, as you started it, change either the investment or your business practices?
I don't think it changed anything from an investment perspective. I don't think it changed anything about how we ran the business or did our line jobs. I think it changed a lot about how we thought about people and how we thought about time frame. That we weren't thinking about quarterly numbers or annual numbers. It was, where are we going to be in 5 or 7 years? Who works here that we want to be a partner 3, 5, 7 years from now? Who do we want to be working with over the next 20 years? That change, I think, was an incredible cultural positive for everyone here, but it really didn't change. The culture was already set in terms of how we thought about investing and how we thought about servicing clients.
Yeah, I do think we became more disciplined about saying no to prospective clients that weren't a good fit. I think we always wanted to be that way, but it's pretty hard in the beginning to say no to revenue. And we made some mistakes along the way there. But once we were comfortable, once we knew we were a company built to last, we could then say, even for clients that wanted to hire us and that would have moved the bottom line and, probably would have been good, but there might have been a mismatch in fit, in needs or whatever, I think we got better at being able to say no. So the quality of the clients, I think, improved because it was more of who we wanted to service and who wanted to hire us.
Mm-hmm.
As we roll forward to the other bookend where we sit today, how do you think about the current state of play in the multifamily office space and where you fit into that landscape?
It's changed a lot. You know, we had a lot of, in the last 5 years, we had a lot of firms that we consider our peers, great competitors of ours who've chosen to exit one way or the other, either through a roll-up strategy to PE, gone public, sold to banks. And we look around and there's not a lot of firms like us anymore who are independent, 100% focused on wealthy families. And yet we think it's the right strategy. We think that works for us, to all the points that we've talked about today in terms of early decisions we made to create longevity. But now there are a lot of firms who used to look like us who are now part of a much bigger suite of offerings, right? And they might be a firm that in the past, like us, didn't manage any internal money, weren't private equity investors, weren't hedge fund managers. They themselves were allocators like we are. Well, now they're not. Now they're at a product shop. They've got good products in-house. And that's who we're going to be seeing in RFP situations. Right. And I think the same thing's on the service side. Firms that have sold to bigger shops that have internal accounting firms, that have internal insurance agents, that have focus on philanthropy internally. We are still a boutique, and at $32 billion, we're a big boutique. Mm-hmm. But it is different from firms who we thought of as sort of in our space head to head, who are now multiple times our size because they're just part of much bigger institutions.
Right. As Evan used the words, I can't believe I'm actually saying this 25 years later. I think we're probably one of the largest, if not largest, independent boutique firms in the space. For us, going forward, I'd like to be able to say that for decades to come.
The goal is to be small enough to care, but big enough to matter. And I don't know what dollar size that is. That's where we feel like we are today.
Right. And we can have a boutique mindset as we get bigger. And so I think, again, part of the culture of the service and the customization just needs to not ever change. And that's part of our job to make sure that's the case. Yeah.
I'd love to unpack how this works. So as an example, I call Brett next week and say, hey, we just sold Capital Allocators for, $2 billion cash.
Hold out for
on the
more.
Cheap. Yeah, I don't know.
Well, we'll see what happens. I'm going to talk to a whole bunch of people. I'm going to come in and talk to you guys. How do you start the process with a new prospect of what it is you're going to be delivering? And I guess there's two sides of it, right? There's like, how are you going to take care of me? And then there's the investment side, and we can do those separately.
Well, we would say the investment side is part of if not the primary way of taking care of you.
You can tell we both jumped on that the same way. Yeah. They're together. And the very first question I'd ask you is, what do you think some money's for? And our goal is to help you achieve those objectives. And for every individual family, those objectives are different or articulated differently.
Yeah, I think if you were to line up and do a beauty contest, and we lead with, well, Ted, what's that? Congratulations, it's big exit, way to go. Podcasts are really hitting it. And then to say, and instead of like, okay, well, tell us everything you're invested in, it's back up. What's your wealth for? And that leads to a discussion. There are so many times in those first meetings where we're not opening books. We're not going through portfolios. Eventually you have to get there. But the first discussion is really orienting around what is your mindset now that you've had this big exit. There's so many ways to figure out what it is that like the money means to you, that drives all of our future discussions.
Whether it be how you build a portfolio, how you structure your estate plan, how you think about taxes, how you think about philanthropy. So all those wealth management services, as well as even the administrative stuff about the complexity that comes with that level of wealth.
After doing that 190 times, right, so much of money is tied to psychology, as you said, people's experience growing up. Maybe they have some sense of what they want to accomplish. How do you figure that out with them?
Yeah.
So it has always been the same philosophy, but how we've articulated it has gotten more and more sophisticated over time. And actually, the '08 experience was important for us. We always highlighted that you had to think long term. If you tell me I'm so long term that I don't have to care about mark-to-market volatility, I would tell you, no, you're wrong, because Evan highlighted it in '08. One of our core philosophies, and I think one of the biggest value adds that any investment advisor can provide, is to rebalance and stay the course, i.e., we're losing money, let's buy. We've made more money than we should, let's sell. And let's rebalance back to those targets that are set based on what your objectives are and what you want to achieve. And if in '08 or 18 or 2020 with COVID or '01, '02, like our 25 years, we've gotten to live through some pretty ugly markets. We now sophisticatedly call them turbulent regimes.
So I'd love to turn from that over to the investment side. Once you have at least a sense of what you think, say, that asset allocation is going to be. Brett, we talked about this on the podcast like 8 years ago. I'm sure a lot's changed since then. Why don't we start with the most important principles that you take in your investment approach?
Sure. And I would say these are not revolutionary. They're core tenets. And I would hope that other thoughtful investment firms would have similar ones. But for us, it's long-term compounding. It's that diversification is the only free lunch in investing. I think we think about diversification a little bit differently. We talked about mean reversion and rebalancing, but for us, that's also being comfortable being contrarian. And people talk about it, but I think you have to be very thoughtful about it ex ante so that you can do it in the moment, because it's really easy to talk about and really hard to do. And so you need to have the plan for it. And then a willingness to be, I call it tactical, but it's really opportunistic. We're not market timing, but what's interesting in the market today is different than what's interesting in the market 2 years ago, 6 years ago, 8 years ago. And so as much as we've got this long-term strategic plan, we need to understand that sometimes things are really interesting in certain sectors and other times they're really uninteresting, and be flexible within that strategic plan, having those tactical shifts. But it's really more of taking advantage of opportunities.
So in that framework, you mentioned that you think about diversification differently. How do you think about it?
So we allocate to strategies, not asset classes. And, we talked a little while ago about David Swenson and stocks, bonds, and other. We never talk about stocks or bonds or others. We talk about active equity or public equity strategies. And those public equity strategies could be passive or active. Those active equity strategies could be long or long short. Equity strategies could be private as well as public. And just because it's a private equity strategy doesn't make it some magical, mystical alternative beast. And just because it's a public active equity strategy that's long and short also doesn't make it some mystical hedge fund beast either. And understanding what are the drivers of those returns, what's the right price to pay to get those returns, and who are the best practitioners in the spaces we want to be in each of those sub-strategies. And I think that's different than certainly most other folks who just say, oh yeah, we're going to allocate to hedge funds. We've never allocated to hedge funds.
How do you then categorize those different strategies?
So we break everything into stable returning lower risk strategies and higher returning higher risk strategies. And if you think about it, that's the 60-40. There's just so many other things we can do within both to build much more attractive portfolios.
On the tactical piece, or that opportunistic piece, how do you think about when to do it and how to size it?
It really depends. Sizing is very client specific. And so I describe how we build portfolios for clients as a giant matrix. And the firm, this was an evolution as well, where early on all of us did everything, and then ultimately we have and now do have a very specialized investment research team, and we have a very, very specialized high service portfolio and wealth advisory team. And so if you're a family here, you've got an advisory team that's thinking about your objectives, how you should be allocated, and all of the other wealth management services that go hand in hand with that portfolio, asset location, portfolio construction, risk tolerance, how big things can be. So think of those, as a column. And the rows are those strategies I just talked about. The investment research team's job is to define the rows and hire and monitor the managers that fill out those rows. And obviously there's a ton of customization around that.
So as you look forward now to the next bookend, 25 years out, how do you think about how you're trying to position BBR for the next generation and the next generation after that?
Well, we do have a meritocracy here. Much as we talk about teamwork, everybody has a role, but the meritocracy is that we want ambitious, successful people here at BBR to become partners. And when they're partners, they own the firm. It's not a profit share. It's not a formula. They have capital value. It has real equity value. Brett and I and other founders are committed to providing our equity to this new generation of partners in a way that allows for us to be able to give people the chance to be able to say, just like it has for Brett and I, this is their firm. And so we now have an amazing CTO. We have an amazing head of innovation who are partners of the firm, who are rethinking the way in which we have structure in light of AI, in light of all of the changes that are going on. And we're committing real dollars to those efforts, both in terms of systems and in terms of people. And so it's just this mindset that you get into, a little bit back to your question of what changed in 2010, which is, these are, if we were looking to try to maximize 2025 cash flow, we wouldn't do any of that, right? But if you're looking to maximize 2035 cash flow, you're just much more willing to invest in long-term positive NPV projects that will make us a better firm.
A little fist bump here. There we go.